Hey there, Blockhead traders. Here at Blockhead Traders must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of January 12th, 2025. And in this week's episode, it's just myself, Sprocket888, and I want to take a look at the index of the Russell because this past week an opportunity came up where I could sell some premium on the Russell to really kind of help build my portfolio theta. And we'll get into a little bit more about that trade, but it wasn't really expected, but there was a little bit of volatility and a pretty strong downward move, which pushed the spot volatility of the Russell up into the range where I really consider selling premium on it. And, you know, with the indexes, I don't really follow as much of the percentile that I do for equities. But what I do is I kind of look at the spot volatility. And in my experience with the Russell, basically 25% and higher, I will consider selling premium against it. Anything much less than 25%, and I'll probably steer away from it. So I'll talk a little bit about what happened to the Russell this past week and why I jumped in on a couple of trades there. But before we hop to that, I want to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're interested in. Love to hear what type of stuff you're trading. Also, you can find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts, so look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. And in this week's episode, it's going to be a pretty brief one, but I'm going to talk a little bit about a surprise trade on the Russell that I decided to take. Now, going into this past week, I really had done my pre-screening over the weekend where I kind of just look for, hey, what's volatile, what's interesting to play, and really nothing was coming up. There was a few earnings on Friday around Delta, but they weren't really quite at the levels that I wanted to trade. The premium and volatility was just a little bit too low. So I decided I wasn't really going to take much of a trade. And then as the week kind of went on, and we started heading into Thursday. Now, Thursday, the markets were closed in honor of the passing of the former president, Jimmy Carter. However, futures and bonds markets were open for a little bit. And kind of heading into Thursday morning, I was kind of looking through the futures because they were going to trade up until about 9:30 a.m. And I noticed that they were really dumping hard. And whenever you kind of get the immediate dump hard of something, a lot of times you'll kind of get a spike up in volatility. And so on that Thursday morning, I noticed that the Russell, which is an index that I love to trade, it's a small cap index, tends to be a little bit more volatile than the S&P, as well as the NASDAQ, at least as of recently. NASDAQ, once upon a time, used to have a good bit of volatility, but it's really been going up and to the right pretty hard. And so a lot of its volatility is not really at the level of the Russell. And the Russell kind of gets thrashed around about quite a bit with small caps and just a lot of the news on inflation or tariffs. And, you know, it goes one way one day and another way another one, and that really kind of pumps up the volatility. Well, heading into Thursday, there was kind of a lot of fear, I guess, going in because it was really dumping hard. And the spot volatility, which is really what I look at when it comes to indexes, particularly indexes and futures options, they really don't get much above 25% historically. So when you get above 25%, that's really where it's kind of a no-brainer to sell the premium. And that morning, the Russell was kind of creeping up close to 25%. Now, I usually like to target around 21 to 30 days expiration. I try to keep it a little bit shorter on the future side because they tend to decay pretty good, but not quite like equities. Equities, I'll go out maybe 35 to 45 days. When I'm selling options on futures, I'm really looking, 21 days to 30 days as the optimum entry area for those. Now, I noticed kind of closer to the expiration of where we were around that 21-day mark, the volatility was just maybe about 22 and a half. Wasn't really quite where I wanted it to be, but I noticed at about the 35 days to expiration or around the February 14th, we were peaking up there at about 25%. So I went ahead and just sold a put on the Russell. And I'll show you some of the chart action that I was kind of looking at, but we're really approaching what I consider a potential bottom end of a trading range that the Russell might be settling in on. And so, at 25% spot volatility, 35 days to expiration, I really needed to pick up some more daily theta in my portfolio. And the indexes, particularly futures indexes, are really what I like to bring on to grab that daily theta. They tend to be a little bit more stable, a little bit more reliable than equities, although not much. And so my portfolio really tries to target with my size around $300 to $350 dollars in daily theta. Now, remember, theta is the amount, assuming the markets don't go anywhere, the amount of decay you get from selling your premium every day. So that target of $350 is roughly where I'm trying to get at from a daily profit target. So basically, I'm looking for $350 of decay about every day that goes by. And my portfolio is a little bit low on daily theta. So I said, hey, this is a perfect time to grab some of that. So before 9:30, I went ahead and put an order in around the 20 delta at the time, which was a 21.25 strike. And I got filled for $12.50. So that was great. And I thought, wonderful. Thursday kind of went through. Friday was a big jobs report number. And everybody's really been looking at the jobs report lately because they're looking for signs of potential ignition of the inflation. And so if the job market kind of keeps picking up steam and exceeding expectations, they're saying there's a high probability that will kind of refuel and re-spark inflation again, as it's kind of been trending down, but they're really looking at that. Well, the jobs numbers came out at 8:30 Friday morning, and they were basically double estimates. And so again, on Friday was a massive trading dump across all of the indexes. And so anytime we get one of those, I hop into the futures and the options, and I try to look at where the spot volatility is. So now the spot volatility was creeping up even higher up, closer to where we are now. And so on Friday the 10th, I was able to enter yet another trade selling more premium on the Russell because it had spiked up about 21 days to expiration. Basically, the end of January options were up pushing into the 25% spot volatility. Well, like I said, that 25% is really the maybe enter, maybe not enter. If we hit 30%, that is a definitely selling premium on that level of volatility. But 25 is really kind of where I start to strongly consider it. So I entered another trade there. This one decays a little bit faster because it expires sooner. I picked up another $8.35 on that one on Friday. So what that really looks like, I'll go ahead and pull up some of these things because I want to keep it framed with the daily theta because that's my goal is to grab more daily theta. And like I said, I'm targeting 300 to 350. My portfolio probably needs to pick up about, I would say, around 200 in daily theta right now. And so these two positions that I put on, the first one, which expires in February, is about $45 in daily theta. And the second one, which expires sooner at the end of January, was about $52 in daily theta. So you can see right there, I grabbed almost $100, almost about half of the daily theta that my portfolio I was really looking for. So the return on capital here isn't that impressive because a lot of the futures do take quite a bit of buying power. But I think that has to do with the notional size of them, and they're so large in their contract representation of the notional value that they represent. However, they tend to be a little bit more stable as far as consistency and things like that. So like in this trade, I'm basically picking up $2,085 between those two trades, about $14,000 in buying power. So we're looking at about a 15% return on capital. Not my highest return on capital. I like to usually see that return on capital above 20%. However, because this wasn't really an earnings trade, it wasn't necessarily a higher risk trade. It's really in line with kind of picking up a consistent daily theta position. So I want to take a look at a little bit of the chart because that's kind of important as to, why was I so confident that at this particular level to go ahead and make these entries. Now, as I pull up the chart here, I wanted to call out a couple of things that I was seeing on kind of the price action, the trend of the Russell, Now, none of this was an absolute perfect entry, but like in past videos, what I really say is I kind of focus on the premium first, and then I kind of look at the play and the strikes and the level, and then I kind of frame it up with price action and historical trends and stuff like that with the chart to see, how far off, where does that fit into it from there. And so keep that in mind as we kind of enter here. And this is basically looking at the Russell. These are daily candles over the past year. And what I really want to kind of call out here is we've really been on an upward trend and upward momentum. So in past episodes, I've called out this red line here is the 200-day moving average. Yellow is the 50-day moving average, and green is the 21-day moving average. Now, a couple of interesting things happened more recently here. We got the 21-day moving average crossing below the 50-day moving average, relatively bearish. We've got a big pullback from about the 24.77 high here that we hit just back at the end of November. And we've really, really fallen off, and we're basically right here at that 200-day moving average. So what did I see about this? Okay, so the biggest thing that I saw here is that, moving averages aside, right here, this big jump, this was basically at the election time. Right after the election, the Russell just took off to like a rocket. And it basically took off from this, 221 or 2200 to 2230 level. And so we're kind of coming down right there to challenge that level. And that was a historical level here of support. And so, we're above it, and potentially we could be in a range of support here again. And so then selling about a 20 delta out, drops me close to that 2100 mark down here. Now that's interesting because that 2100 was previously, you can see, a point of resistance around, end of March. Again, it was resistance around mid-May. And then eventually we broke above it and then kind of went up into that higher range. And so, that 2100 is at another level. So we got two interesting levels that we're at. We're trading basically close to a particular price action level, not to mention it's also at the 200-day moving average, which, if you look back at this chart, has again been a sign of support. Sure, we might wick below it, but a lot of times here we got a hit back here at January of last year. We hit the mark here around April, mid-April of 24. Got close to it here in June of 24. We hit it again in August of 24. Pretty much touched it on a wick here at September of 24. So you can see this has historically been a line of support. And so these things are kind of adding up. Nothing is ever a sure thing, but it's these signals that give me a little bit of confidence that there's a high probability that we'll get a reaction in the direction I need. And remember, I'm selling time premium, so it doesn't really matter. I don't really need a strong reaction. I just need things to stall. And basically, my two strikes, one was at 21.25, one was 2100. So you can see that's a good bit below, but also those previous levels. And so going into this, those were things of that chart that I was also looking at. Now, that's all well and good at the daily candle level. That's a little bit zoomed out because remember, these trades are 21 days and 35 days out. So if we take a more zoomed in approach at some of the charting, and I'll switch over here to a trading view thing. And there's other things marked up on this chart because I'm always constantly kind of checking the Russell and following it and marking different levels. There's a couple of interesting things I want to call out. So this is the upward channel, this blue channel that's kind of up and diagonal here. These are all 4-hour candles. So this is a little bit more appropriate for looking at such a short time frame. And what I've done here is there's a lot of red boxes. These are previous Russell trades that I had taken. What's interesting is right here, the last two red boxes, you'll see two of them overlapping. The first one is the expiration that's a little bit farther out, 2125. The other one is expiration that's a little bit sooner at 2100. And what I want to kind of call out is this channel. Now, historically, a lot of times when I chart these channels, this is a different type of kind of price action or technical analysis that's a little bit more trend-based, I guess you could say. A lot of times you'll bounce around these channels, low to high, low to high, low to high. And then you are in for a potential reversal once you break through, or a different type of trend once you break through either the top side or bottom side of the channel. And then as of note, basically on the 9th and the 10th, we broke through the bottom end of this channel. Now, what I have typically seen in this kind of channel stuff that I've charted over the years, particularly with indexes, is that you will kind of maybe drop even further. You'll get a rally back up to the bottom of this channel, at which point you'll kind of either get a confirmation of the reversal where this bottom end of the channel will become resistance, and you'll kind of reject off of that. In that case, you're likely looking at a lower or definitely a trend in momentum. If it breaks through that when it kind of comes back up, it's kind of just a false, didn't really bust through, and we might be maintaining that current channel. So that's interesting because none of that stuff typically happens, in just 1 day or 2 days. So I'm not really looking for in a few days to get this massive swing down, massive swing up, right? So that's why this timing is so important, is because there's a high probability, in my opinion, that we are going to maybe drop off a little bit, rally up, and kind of challenge this. And even if we challenge this, if we go higher, wonderful. Even if we go lower, the probability of going lower from this bottom end of the channel down below where my strikes are is relatively small, given the time. And all I'm looking for is to burn that time premium off of the position that I have. And so it's all of these things that kind of come together that gave me confidence that this was one of the trades where the probability is greater in my favor than a simple 50-50 equity trade, because I'm selling that premium. It's a 20 delta, which basically means there's about an 80% chance that my theory is going to be correct. And then that's further backed up and substantiated as I kind of look at the charting. And we'll see how it goes from here. 100%. I could be wrong, and this could just prove me wrong, but I'll keep an eye on it on here and show you how it plays out over the coming weeks. Because by the end of January, one of them will be out, and then 2 weeks into February, the other one will be out. So that brings us to the end of this week's episode. Like I said, it's going to be a quick one. It was just a quick one because I didn't really anticipate much of a trades this week. We got a couple of volatility that really popped up last minute towards the end of the trading week. I took an opportunity to jump on that and to grab some daily theta by selling premium against the Russell, where the spot volatility had kind of spiked above that 25% spot volatility mark, which is really one of the thresholds of my entry into selling premium on the index. Historically, if the premium is below 25%, it's really not worth the risk on entering that. You just don't get enough juice from the squeeze, if you would. But anything above 25%, closing in on 30% is definitely a jump in, and that's not a level that gets hit very often. I would say over the past year, we really only got above 30% once, maybe twice. And so that's why that 25% is really when I start looking, because that level gets hit a handful of times a year on the indexes. And so that's always, or at least in my experience, been a very good entry point. And options on futures are one of those things that carries a very high notional value. They're very good with buying power, so they're very buying power efficient relative to the notional value that they represent. So it is a very good way for me to grab a lot of daily theta for my portfolio. And so, I target around 300, 350 with my given size. And this particular trade at the end of the week, I was able to pick up about a third of the daily theta that I like to keep in my portfolio. So I'll keep you guys posted as the trade kind of pans out and the coming weeks roll out. We'll see if it was a good one or a bad one. Remember, I'm really only looking for about 50% of what I collected. As soon as I cross that threshold, I will probably close those out and then go back to looking for other trades. So hopefully you're finding things as the market is really getting up to speed here in 2025. Good luck out there. And remember, think outside the block.